Okay, well, welcome to this webinar looking at ESG and valuation as part of the IVSE's Valuation Webinar Series 2021, sponsored by Duff & Phelps, a Kroll business. Shortly, I will hand over to the moderator for today's webinar. But before we get started, just a quick reminder that this is part of a 5-webinar series being hosted by the IVSE and Duff & Phelps during May. Our final webinar takes place at the same time tomorrow, and we'll explore the impact of reforms to IBOR on valuations and the valuation profession. You can still register to join that webinar through the IVSC website at www.ivsc.org. During today's webinar, you will be able to post questions to the panel using the Q&A button on your screen, and I'm sure they would welcome the more questions, the merrier. As we will also have polling questions throughout the session today to capture your views on certain ESG related topics. Finally, the views and opinions shared by our panelists are for the purposes of this discussion and do not necessarily reflect the positions of their organizations, the IVSE or Duff & Phelps. Our moderator today is Anton Colella. Anton is a trustee of the IVSE and the global CEO of More Global, one of the world's leading accounting and consultant networks. So with that, Anton, I will hand over to you.
Thank you so much, Richard, and warmest greetings, colleagues, wherever you are in the world today. I'm actually dialing in from Scotland. I hope you can understand the accent and we don't need simultaneous translation. But we're delighted to have so many of you here today. We are also delighted to have such a great panel who will introduce themselves in due course. But before we do that, I just want to say a few things about this. Who would have thought that an IVSC webinar on ESG really is about changing the world? And that's where we want to begin this discussion. We've used the phrase ESG so much that I think it's just become part of our common business parlance. But when you get underneath it, we really are in the business of changing the world. And what we're not talking today is about primarily the technicalities. We will get to some of that. But what we're looking at is how we can address very real things in the world in a business context. And we see this with the current environmental disasters that we're dealing with. We see social unrest, and we see the impact of governance in this post-pandemic reality. These are real and tangible issues. They are not hypothetical. The challenge here is when we start to look at ESG and its impact on value creation, how do we make sense of a very disparate and inconsistent environment where there is a lack of uniformity of results, standard, and everybody is approaching this differently. And this is where we come in as a profession. Our job is to make sense of it. And today we're addressing the valuation profession. We're addressing this as trustees of the IVSC. And today it is so important for us to address these things in a way that we can make sense for our clients, for our communities in which we work, but also for the whole of society. No small task indeed, ladies and gentlemen. So we're delighted that we have you all with us today. I'd now like to begin this by asking our panel to give their perspective. And what we have is the perspectives of regulator, valuer, boardroom, and also transaction advisory services. So what I'm going to do is I'm going to hand it over to each of the panel members just now to give us their perspective. But before they do that, I'm going to ask them to introduce themselves as they begin. So first of all, can we get a regulator's perspective? Ranjit Singh, over to you.
Thank you very much, Anton, and good day to everybody who's joining us from all over the world. It's a great delight to be able to share some remarks with a cross-section of audience around the world. Let me, my background very briefly has been as a market regulator, and I was the former deputy chair of the International Organization of Securities Commissions, who oversee securities markets, as well as chair of the SEC in Malaysia. And I currently am affiliated with the work with the International Financial Organization and do work in the area of climate disclosures, as well as in financial regulation advice. And of course, as Anton and Richard pointed out, I have the great pleasure and honor of sitting with some of my colleagues on the board of trustees for the IVSC. In the interest of time, Anton, would you like me to continue, Anton? Or yes? Yeah. Yeah.
Over to you. Yes, you have the floor.
Great, great.
Can't wait.
Thank you. Thank you very much. Well, I mean, as Anton has pointed out, this is clearly becoming a major area of focus. And I, began looking at this issue about 9 years ago in 2013, when I chaired IOSCO's Emerging Markets Group, and had also been involved in the formulation of the ASEAN Green Bond Standards in there. And I must say that was a time where it was very difficult to get people convinced that this would be as mainstream as we see it today. There was a gradual pickup. Many, viewed this as a CSR work, and there was a very, gradual, pickup in terms of how, you would start getting people focused on issues of sustainability and certainly climate. But clearly, the events, the recent past 12, 18 months with the COVID crisis has clearly demonstrated how, extreme tail events such as COVID can have such a massive disruption in terms of our lives, society more broadly, as well as economic and financial systems. And therefore, brings very starkly the message to us that we just cannot afford not to start looking much more deeply into the risks associated with sustainability and ESG issues more broadly, and of course, more specifically around climate change. Now, as we look at these issues, whether, trying to obtain information to assess risks associated with these segments, to be able to provide more effective market pricing of these risks, to enable, informed investment decisions. And we've seen this very sharp growth in ESG funds that have taken place, as well as a very large, significant growth in the amount of sustainable and green bond issuance. And so to allow informed investment decision making and to enable the mobilization of sustainable finance, particularly for climate mitigation adaptation, in my view, speaking as a policymaker and as a former regulator, I think it is absolutely imperative that we focus our attention on what I would describe as the information architecture of sustainability. And what I mean by this information architecture is really, putting together what 3 interconnected building blocks within this segment. And these 3, building blocks are intended to provide greater decision useful information. And they comprise of 1, high quality, reliable, and comparable data, which is absolutely important. Secondly, a harmonized and a consistent set of climate disclosure standards. And thirdly, a broadly agreed upon global taxonomy. And let me just turn briefly for each of this. I think in respect of data, there is, there is really a major gap in terms of forward-looking and granular data, and in respect of climate sustainability issues. And what we really need is consistent, comparable data with a common set of definitions and standardized metrics. And also, we need to find ways to ensure that this data is, accessible. And there are technology solutions that can be enabled here, but there needs to be effort directed at this level. Now, there are some initiatives currently happening. This is around climate change, indicators by the IMF, and GFS is doing work on this area, the Network for Greening the Financial System, and the Financial Stability Board. The second area is around disclosure standards. Now, I think on climate disclosure standards, as as mentioned by a former colleague at the international level, I think the regulators are moving at really, at warp speed here. There is, in the last few months, a tremendous momentum to address the fragmented number of disclosure frameworks that existed. And we're seeing now a coalescing of efforts. But what we really need is a coordinated international effort to develop a global set of reporting standards. Fortunately, we have seen recent efforts by the International Financial Reporting Standards, who are aiming to put forward a sustainability reporting standards board, which I think is very useful. But they should build on the current, frameworks by the TCFD, as well as the voluntary standard setters, which is important. And I'm sure we can talk a bit more about this later on. The third area, which I think is relatively less developed than the first two, is around taxonomies. And I think it's very important that as we look at this issue, we recognize that taxonomies can play an important role in facilitating investments to mitigate climate change. And therefore, efforts must also be directed to develop, at the very least, some common basis and broadly agreed upon taxonomies. We see the EU effort, which is extremely commendable. We see efforts by several jurisdictions, but I think this is an area which also requires equal focus. So I see this, information architecture as being critical, Anton, within these three components. I'll stop there.
Thank you so much, Ranjit. That's excellent to get your perspective. I just want to give a reminder to all our participants today. We want to hear your questions. We've got a good bit of discussion still to come. Now, let me hand it over to Suzanne to get a valuer's perspective. Suzanne, if you could introduce yourself then, over to you.
Yes, thank you very much. So yes, I'm Suzanne Ilau. I'm from Germany. I'm partner at Mazars, and yes, and I'm working on valuation and practice for more than 25 years. I'm also a member of the German valuation standard setters, and yes, and here I'm a member of the IVSC working group regarding ESG. So therefore, yes, I also have the view of the IVSC, and yeah. What I really would like to say, and what is quite important for me, is that really companies that consider ESG issues achieve really a better corporate financial performance. So, and therefore, what we see also in practice. So, and there we can see, or I would see it in three levels. So, first of all, the corporate management is really required to consider sustainability aspects for getting a positive positioning on the capital market, as well as the corresponding ratings in the future. And also then, if you look at the investor's perspective, then really you see that investors will include responsible companies into their investment decisions. Yes, they have in the end higher chances of a positive performance of their portfolio. So, and yes, and the third and also really important aspect is that sustainable activities will have an impact on the value of the company. And so if you start with the corporate management, really, if they consider sustainability or ESG aspects, then this leads really to on the one hand, to the reduction of risks. It increases the corporate reputation, as well as it will bring benefits for all stakeholders. And this is also what studies have shown, that ESG information influences the performance and the value of the companies. And yes, therefore, we really can see that it is quite important to consider these issues. But on the other side, that's what we all know, these are mostly non-financial aspects. And therefore, it is really a challenge and a practice to analyze and to evaluate these factors. And yes, and both, and in the end, incorporating this ESG framework in the company valuation procedures really requires, in the end, an education of both of the management. They have to learn, and also the valuer. The valuation practice has also to learn a lot regarding this. So, and yes, and if we look at the investors, that's also what we really see, yes, in their investment decisions. So they quite often rely on ratings. And this is another, from my point of view, quite important aspect that we, at the moment, we see a lot of ratings and different kind of ratings with a very widespread on business valuation. And that's what I think what really need to has to be improved, is that we get more consistency and more, that also these ratings get more transparent, and I think they need a lot of improvement. And also at the moment, if investors, if they only rely on these ratings, I think this is too short. Yes, in the end, you probably should also conduct your own analysis regarding this. And then really, if we come then to the business valuation itself, then in the end, you have on the one hand the market approach, and if you use this, then you really need to look at comparable companies. But then again, it is quite important to look how they consider ESG factors and in their performance also, and if it is really comparable with the company you are valuing at the moment. So this is quite important. And yes, and the other very often used approach is the income approach, and therefore you need to look at the future cash flows as well as at the discount rate. And also, yes, if you invest in ESG areas, then it quite often at the beginning has quite high investments. Yes, and on the other hand, you have to look when you will get really a return on the investments, but in the long run, usually these benefits should really override the costs, but that's also what you have to look later on in the business plan. And on the other hand, you can really minimize risks by, for example, averting penalties or reputational damage, because this is quite important. And that's also what I said before. Quite often ESG measures do not really influence the short-term business plan or short-term future, but they have a really important influence on the terminal value, yes, on the sustainability of the business model and the company in the end. But additionally, there's quite a risk of double counting of ESG influences, especially if you look at the cash flows and the discount rate. Yes, and then really to say what are we doing from the IVSC side with the ESG working group? Yes, I think at the moment there's not a shortage of opinions in the market regarding ESG and how and if to consider and really, and also it is not only, or the first step is perhaps also to look at the standardization of disclosures and reporting, and that also later on impacts the valuation, especially the external valuation. So yes, but anyway, I think also for all valuation professionals, it's really important to take care of all these ESG considerations and to put them into the valuation and to find ways in the future really almost also to quantify these issues. I think this is one of the most challenging issues.
Well, thank you so much, Suzanne. And it's great to see the questions coming in. Whether we get a chance to answer them all is another matter. But I see Stephen, Chris, Varun, Vincent, Alexandros, a few anonymous, Gotam, they're all coming in and they're covering every topic related to this. So I'm not sure we're going to be able to answer them all, but keep them coming in. But now can we get a perspective from CFO, boardroom, and Alan, the global accounting profession? Over to you.
Thank you, Anton. Good morning, good afternoon, and good evening, everyone. Thank you for joining us today. It's really a pleasure to be on this panel with such eminent speakers. So I'm the president of the International Federation of Accountants, and I'm also on the board of trustees of the IBFC. I also sit on the board of a listed company in the UK as a non-executive director, and I'm on the audit committee. I also chair the board of a British school in Portugal, and that's something which I find most exciting. And it really does relate to the topic of today. I was actually there last week, and speaking to students, it is just amazing how they get the topics that we're talking about today. I don't remember having these discussions with my schoolmates many, many years ago. They get it. They care about the planet. They care about society. They care about the environment. And they're talking about it and they're demanding change. So that's good. So we have obviously the demands from the investment community. We have the demands from the other stakeholders, from policy makers, regulators, but more importantly, we have a huge demand from the next generation who want us to make the world better than what we are leaving it with over to them. And I think that's something that keeps me focused on things that really matter. So when we look back to the past 16 months or so, we've spent a lot of our time talking about and dealing with the COVID-19 pandemic, and it has been tragic. And Sanjay talked about the economic impacts, the societal impacts, etc. But what we have seen is significant collaboration and cooperation taking place across the world to find solutions to the pandemic, something that probably has been needed for the ESG space, particularly environmental and social matters. So I'm really pleased to see that when we do collaborate and cooperate, we can come up with solutions to address challenges. But of course, the COVID-19 pandemic, we will deal with, hopefully. It will take time, but we'll get there. The bigger pandemic, which is the environmental pandemic, has been around for decades. And if only we had addressed it in the same way with speed and agility and collaboration and cooperation, I think we'll be in a better place. But all is not lost, because now I would say that companies realize not only is the climate risk real and it will affect everyone, but actually it will affect whether they stay in business, whether they have a business in the future. So what I'm seeing across boardrooms today is that this is very much at the heart and center of the board agenda. It's no longer something that's discussed in addition to the business strategy. It is very much part of the business strategy, and that's good. I certainly remember in my days in Unilever when we decided to publish our first sustainability report in 2006, we talked about whether we should have it assessed independently. And I felt we should, not because I thought it was perfect, but because I thought the rigor and discipline right across the organization in over 130 countries around the world, it was important that we took it seriously. And when you report what you're doing, you're then going to be held accountable. And therefore, I was very pleased we did that. And I would just say that, you know, my experience, I joined Unilever in the late 70s and I was there for over 30 years. I joined Unilever at the time because I generally believed it had a purpose that embraced ESG. We didn't call it ESG at that time, I must say, and whoever coined the acronym ESG deserves a huge amount of credit because all three link so well together and are integrated. But why did I stay for over 30 years? It's because we were addressing these issues then. We understood what we needed to do. We understood we needed to hand over the business to future generations and make the world and society a better place. And I honestly believe that we're now seeing that purpose at the center of businesses everywhere in the world. And I'm really pleased to see that. Thank you.
Thank you so much, Alan. Very much bringing a broad range of perspectives there. Last perspective we're going to get is from Andrew, bringing that transaction advisory bit, the investor perspective, which is absolutely key here. Is it real or is it not real, Andrew? So you'll give us yours. So over to you, Andrew. Thank you.
Thanks very much, Anton, and good morning, good afternoon, good evening, everyone. I'm a managing director within the transactions advisory practice at Duff & Phelps, but have been an accounting advisor practicing for over 20 years and have seen some quite dramatic changes during that time. It's great to be involved with this discussion and such a prestigious panel. And as Anton says, I'll be providing some insight from the perspective of not just a practicing accountant, but also as a transactions advisor. And Anton, you commented that we all have a part to play in changing the world. I'd probably like to go a step further, and I won't say that I came up with the phrase, but I think accountants will save the world. And I know that's a slightly provocative statement, but I think the discussion today will show why we've got such a significant part to play in that. And when you're dealing with any sort of change, I do see the shift towards integrated ESG reporting as a hugely important change. It's always worth starting with the question, why? And that's not to mean why should people care about ESG? I'm really hoping that's obvious to everyone. But in the context of this discussion specifically, why should companies, investors care about ESG reporting and the quality of that? Especially if, as suggested by some recent publications, there may be no such thing as ESG alpha, or at least any correlation between ESG scores and shareholder returns has yet to be proven. Now, we're doing our own study on that, and it'll be published later this year before COP26. But for me, we have to take a step back and understand what is currently driving investment decisions, and more importantly, what should be driving investment decisions. And I'm sure all the attendees of this webinar are more than familiar with the concept of equity value and the various methods available to calculate it. However, equity holders only one proportion, albeit a very important portion, of a company's stakeholders. Looking at it more holistically, or perhaps altruistically, the legitimacy of any business depends on its ability to create value for society. And companies also create value for its employees, its customers, its suppliers, and the larger ecosystem, evidence of a business's power to increase collective well-being. And we can review that as the value attributable to non-equity stakeholders. And as Suzanne said earlier, that's intrinsically much harder to value, and I'll be leaning on her for some support on that later. And I know this is something also touched upon in the IVSC's upcoming perspectives paper. Now, cynics may dismiss this as just woke capitalism, or as one of the questions raised already as a Marxist ideology. But personally, I feel there's a genuine paradigm shift in how stakeholders, both equity and non-equity, perceive value. And it highlights the importance about how externalities, such as a business's societal or environmental impact, is driving management and investor decision-making, and can also help in creating long-term value. In a recent survey, over 88% of LPs globally now use ESG performance indicators in making investment decisions. And 87% of those said they invest in companies that have reduced their near-term return on capital so they can reallocate that money to ESG initiatives. This demonstrates that investors and companies are cognizant that what may be deemed non-financial externalities in the short term, greenhouse gas emissions, lack of cognitive diversity, or other matters, become long-term financial impacts once you take into account how they impact other stakeholders. As Alan mentioned earlier, this seems especially important now with Gen Z and millennials becoming the next generation of customers, investors, and employees and stewards of the world. They'll talk with their feet if companies aren't improving their ESG credentials, and government intervention will continue to penalize non-sustainable behaviors. This for me highlights why companies, investors should be taking their ESG initiatives and related reporting seriously. And that's before we even start about talking about the capital markets and how there's been a 30% increase in ESG related assets under management in the last quarter of 2020 alone. And now assets under management relating to ESG are now over $1.7 trillion. Or how government policies come into play, such as the EU's Green Deal and their ambition of being net zero by 2050, are all taken into consideration. But I know there's lots of questions. I'll stop for there now, Anton.
Well, colleagues, you have had perspectives of 4, but we're just beginning here. It's wonderful to see the questions coming in. I'm not actually sure how we're going to be able to deal with them all, but they're great questions. But let's get a perspective from you. So we're going to do some polling questions just now. Richard, can I hand it over to you? So what we want to know from you just now is where you can participate. Where are you in the world? How do you interact with the valuation process? And then lastly, to what extent is ESG integrated into your work today? So please answer the questions now. What geographic region are you? How do you interact with the valuation process? And lastly, to what extent is ESG integrated into your work today? Interesting. Here we see, well, we get 50% from Europe. 68 of those participating today are actually valuers, but we do have 7% of others, which is always interesting. To what extent is ESG integrated into your work today? Intrinsic, 11%. Becoming more prevalent, I think that number is just going to keep growing. It's talked about, but not yet a part of my day-to-day work. Promise you, is going to be very, very soon. But interestingly, the 14% there, you're here because you're interested. It rarely features in your work, but I think we can safely say it is going to be a bigger part of your life going forward. Now, let's get back to the panel. We want to kind of play on their expertise. Ranjit, I'm coming to you first, the regulator. And the good thing is today, we're seeing that corporates are responding to asset owners and activist inventors by improving their own ESG disclosures and credentials. They're doing it voluntarily. But why do we need the involvement of regulators at all? Because you know this, Ranjit, the moment it becomes, the regulators get involved, it becomes a compliance exercise. Is that a good thing, or is it better that we've got them voluntarily doing it? What do you think, Ranjit?
Thanks, Anton. Well, I'm just looking at some of the questions that are also coming in, and I think there were some who were sort of asking the question around, what's the best ESG framework out there, and those sort of issues, right? I mean, if you look at it, I mean, there are multiple frameworks, numbers cited from 200 frameworks in there. Now, and clearly, even from the perspective of valuers, who represent the bulk of the audience, it is very difficult to be able to do what they do in terms of valuation with this proliferation of metrics and standards out there. So in my view, what you really need is this, very clear effort, which is driven by policymakers and regulators. They have to come together to be able to work towards a harmonized set of standards. So primarily, it is around standardization, I would say, Anton. The second, sort of aspect which gets discussed is whether you impose mandatory adoption, right? This is the point about compliance. You move towards it. My own personal view is that I think the focus really at this point in time should be to create this harmonized set of standards. The mandatory adoption pathway has to be looked at, very carefully, both from the perspective of timelines as well as impact in terms of, small and medium-sized companies within emerging markets, etc. So that's where I think, there is a very clear role for regulators to get involved in terms of providing this, standardization. And then clearly, there's a massive proliferation now of efforts in terms of, as I said in the beginning, growth of investment funds. And I think, the questions reflect rightly a certain amount of skepticism around how real this is and how sustainable this growth actually is. And I think part of those concerns emanate from this divergence in ratings, risks around greenwashing, etc. Now that is very squarely also within the domain of the regulators to address. So I think those are kind of things that you need to be able to have their participation in, particularly at a globally coordinated level.
So You would certainly say that regulators do have a role here in the development and ensuring there is adoption. But let me add another part here, which I know you have a strong conviction about, and that's about the implementation challenges in emerging markets here. Do you want to offer some comment there, Ranjit?
Yeah, look, I mean, Anton, being actively associated with emerging markets, my own experience has been that, there are multiple, set of issues which are at play there. When you talk to some of the, jurisdictions, I mean, take the example of the current COVID situation. I mean, this is having a massive health and social impact. Fiscal positions are highly stretched in coping with these issues, and therefore, their ability to be able to spend the trillions required in terms of climate mitigation and adaptation is certainly a challenge. And on top of that, the ability to be able to mobilize the finance for these things also becomes a challenge. So, I mean, these are very real challenges that are being faced within the context of many emerging markets. And of course, in some cases, the S aspects, are more, in many ways, very, very, very prevalent in terms of their consideration. And therefore, I think any efforts towards implementing a global set of standards, particularly going back to your point about, compliance, etc., must be cognizant that that there are preconditions which do not necessarily exist in emerging markets, which might be in the developed market. I say might be because they may have the same problems as well. I mean, things around, for example, collecting data across complex and long supply chains, being able to ensure that you focus in terms of getting information for some of these smaller, medium-sized companies, not so easy. And the other point, Anton, I may make before I stop is the fact that also the way we approach the taxonomies becomes very critical. You cannot take a binary approach for many emerging markets. Many of them are in transition, and therefore the way we define the taxonomies, if it's extremely binary, has a major impact of being able to provide these emerging markets with the critical financing required to be able to transition to a more sustainable climate model, actually. So I pause there.
Thank you so much, Ranjit. I actually want to now have a look at the client perspective. Andrew, over to you, but how have you seen client interest in ESG evolve over the recent years? I mean, particularly in the last 18 months, but also when you're advising your clients today, which framework or standards, and we know we're saying it's really complex, which framework or standards are you recommending they follow?
It's a really good question. I'll answer them in two parts. So in terms of a general interest in the topic area, I mean, it's accelerated exponentially over the kind of past 18 months, and the pandemic has really focused the attention on supply chains and sustainability, but also kind of other issues as well. I mean, you look at, Bitcoin, etc. I know that seems a little bit abstract, but Bitcoin in its own right creates more carbon than Argentina. And so suddenly, and once these statistics start to come out, people start to put everything into perspective, and it starts to impact every single aspect of their life. But from a company's perspective, and Alan touched on this earlier, it's about purpose. And once people have stopped and had time to think about what their purpose is, who their future customers are going to be, they suddenly understand the importance of this topic. And then when it comes to kind of actually disclosure requirements, this is where it starts to get tricky, because I think a recent study highlighted that globally there's over 4,000 different sources of standards, guidance, regulations around ESG, or the various different kind of subcomponents of that. And therefore trying to distill that down is really hard. And I guess that at the moment there's 5 major independent standard setters and then an overarching framework, which are probably the most prevalent and the most important. So that's the Climate Disclosure Project, the Climate Disclosure Standards Board, Global Reporting Initiative, International Integrated Reporting Council, the Sustainability Accounting Standards Board, and then the framework provided by the TCFD, the Task Force for Climate-Related Financial Disclosures. But even those individually, they all touch on different elements of ESG, which is why the IFRS Foundation statement to create a Sustainability Standards Board is so important. And it's just a huge step forward in standardizing all of this. But in the short term, a standardized approach doesn't exist. The best thing that I've seen published in the last 6 months or so was a paper produced by the World Economic Forum. And they've produced a white paper in conjunction with the Big Four about common metrics and consistent reporting of sustainable value creation. And what it does is it creates a core set of 21 metrics and disclosures, but it's drawn from all of the existing frameworks that lots of different people are using at the moment. So that alphabet soup of, as it's called, of different standard setting bodies, they're bringing that all together and kind of bucketing them in, a very similar way of ESG, and they call it people, planet, prosperity, and principles of governance, because they would like 4 Ps, but governance doesn't start with a P. But again, it's all around the same topic, but it creates a harmonized approach that, in my view, is the best way of looking at it holistically until such time as the IFRS Foundation puts forward their sustainability standards.
Okay, it's still not getting any simpler, Andrew. No. It's great. Now, colleagues, those of you that are here just now, I would encourage you to look at the Q&A section here, because there are some wonderful questions. We're not going to get to them all, but some of the questions are actually statements or highlighting some of the issues that we certainly need to be aware of as we go forward. But I want to actually go to you, Suzanne. I mean, the vast majority of the people that are here today are in the valuation profession, but how important is the role of valuation and the valuation profession in this evolution of ESG, given that the intangible nature of many of the ESG components?
Yes, I think it is really quite important because, yes, we have the intangible assets on the one hand, but also ESG has a really huge impact on the future business models. Yes, really on the long run and sustainable evolution and development of companies and their business models, and this leads to, and if you really yes, take ESG factors into your business consideration, then you have really the chance to reduce the risk of your business model, and this also means that you will receive also on valuation perspectives, for example, lower loan and credit spreads or higher ratings. And so therefore, it is, from my point of view, and if you look at the valuation business, then you really have to look at the business plan, because the business plan is very important, and you need to, yes, include all these ESG impacts in of the future business performance also in the business plan, and so on. And yes, and if we come to, as you asked me, what ESG creates, yes, it creates a better performance, but really, as you said, it has really an influence on intangible assets. And in some cases also, intangible assets will be created or will be supported. Yes, if you, for example, look at brand, human capital, customer franchises or technology, yes, and these are all, if you look at, yes, brand is a question really of corporate governance, is a question of social investments, but also of environmental investments. Yes, if you care for your if you care for the society, if you care for the planet and all these things, this increases your reputation, this increases the brand of your company. And even if you really, yes, you can create human capital, but also on the other hand, for example, if you are in a business in reducing energy consuming issues, for example, and you develop a new technology, or if you look at the automotive industry, yes, if they go to e-mobility and so on, these are all investments in technologies as for what we would say, or what Alan said, for a better world. And yes, and therefore, in the end, we are also producing or supporting intangible assets, and then it really depends on which aspect of ESG you are looking. Yes, for example, corporate governance. Yes, you could really reduce risk. Yes, even if you will not have any environmental negative issue or so. Yes, and or if you will protect, for example, bad behaviors regarding all these aspects, then you could reduce the risk of a bad reputation, and also, yes, by social investments you can create perhaps a better cash flow, because you have better customer relationships. You can keep all the staff at your company, yes, and therefore you are better in performing. And yes, and regarding the E, it is really a question. Yeah, quite often you have really high investments, but in the long run, it is perhaps you need it really to have a sustainable business in the long run.
Well, thank you so much, Suzanne. Alan, I haven't forgotten the accounting profession here. I mean, Andrew said earlier on, he's a chartered accountant. He's saying they're not just changing the world, they're saving the world. Alan, what do you think? What's the role of accountants in the accountancy profession in this whole area, but also in the sustainability reporting area as well?
Thanks, Anton. I like the phrase. It was actually Professor Mervyn King from South Africa who wrote a book about that. So I'd also like to just come back. There are one or two questions which I'd like to come to, but I'll start with the accounting profession. I mean, first of all, we're in the business of reporting, right? And we must have an active voice in supporting the global approach, moving away from the fragmentation that we have today to more integration, and my colleagues have talked about that. So that's what we do. What do we do? Our key role is, of course, to bring trust to the information that companies use to communicate with their stakeholders. Trust in business, trust in society is so important today. And that's, what we do as a profession is we speak a common language. And I think we're talking about common languages here. We also need to demonstrate that we have the requisite skills in sustainability and the competencies on the subject matter, so that we can apply these in terms of the preparation of and the assurance of the information, but also how information is utilized by broad stakeholders. And we need to build this within the organizations, as preparers, but not only that, as strategic discussion partners with the companies. Because for me, the reporting is important, but quite honestly, for me, more important than that is the actions we take. Yeah, reporting is of no value unless it's about the actions you've taken and the impacts you're going to have. And I think one of the things that we as the profession need to do is to make sure that the actions are in place, the reporting says what we're doing, and the impact is clear for all to see. So it's about integrating all of these aspects. I would say that assurance is clearly very important, back to this issue of trust. I would like to just maybe touch on the question you asked, Ranjit, about voluntary rather than mandatory. From my perspective, I'm concerned that if it becomes mandatory, it just becomes a tick the box exercise, and we feel it's done. And it reminds me of discussions I had many years ago in the UK about, the famous phrase, comply or explain. I hate that phrase. I think it should be comply and explain. I don't think it should be one or the other, because it just allows you to comply by ticking boxes and you don't explain why you do not comply. So I think it should be both. So I think we have a very important role as a profession to integrate all the thinking, to integrate all the strategic discussions, converting them into concrete plans to which we then agree with obviously broad stakeholders. We then activate those and we report what we've done and the impacts we're having. So that's where I see these. And quite honestly, I don't think we need regulators to mandate it, because as we've heard from the speakers, the demands are there. Investors are demanding it. Broad stakeholders are demanding it. Our business partners are demanding it. And the next generation, as Andrew talked about, is also demanding it too. So therefore, I think there's enough pressure now on organizations and businesses to get this right and address this. There is a question, if I may, Anton, just to pick up, because I like the question. It was from Varun, who sort of asked whether we think all parts of ESG are given equal weight. And he has a feeling that the climate agenda is taking over. And I understand that feeling, and it's probably the right feeling, because indeed there is a lot of discussion about the climate agenda. But the climate agenda impacts the social agenda and vice versa. So therefore, you know, I see them as equals. And of course, the governance, which I've just talked about, is also important, that sits above all of this to make sure we're doing the right things and we're held accountable and responsible for what we're doing. So I think they're all important, and you can't do one without the others. So I would say they're equally important. Obviously, the climate pandemic we're facing is critical, and we see everyday aspects of that. I think Varun probably is somewhere in South Asia from the name, but I could be wrong. I mean, look at the monsoon seasons and the huge damage it's doing, and the loss of livelihoods, the loss of lives, the loss of economic activity that it's having, the floodings, the earthquakes, the pollution. You know, we talk about the COVID pandemic, and sadly, what is it now? About 3.4 million have lost their lives prematurely. But more than 5 million lives are lost every year just from air pollution alone. And yet we've not addressed that as much as we have the pandemic. So I don't see that one is more important than the other. They're all important, but they need to be given that dedicated focus to make sure we now, once and for all, get it right.
But taking your perspective from the boardroom, Alan, is it easier to measure the E? You know, we talk about we value what we measure, but is the E the low-hanging fruit in all of this? Therefore, we've kind of latched onto it, and the S and G are just getting harder to measure, or a consistent approach to how we measure it, from your perspective as an audit committee?
I think that's right, Anton, because, you know, when you look at the E, you can measure outputs, you can measure consumption, you can measure emissions, you can measure your inputs, etc. So yes, it's probably easier to measure, but I just want to go back to the point Ranjit made. The extended and complex supply chains mean that it's not that easy either, because you can measure it at one point, but as we know, you need to measure it from, if you like, from the farm or the field or the sea, all the way to the shelf from the consumers and beyond. You know, the discussions we used to have in Unilever was, we can do all we want about our own consumption and emissions, but what we need to be thinking about is how consumers use our product and what they consume as a result of using our product. Take detergents. We need to make detergents that consumers can use with less water, therefore with less energy, etc. So yes, you can measure them, but let's be honest, it's a very complex set of measurements, which is very broad. So yes, it's slightly easier, but it's not easy at all.
I mean, I was deliberately stoking the debate there because IVSC has issued a perspectives paper on measuring social value. It's on our website, and I would really encourage the audience here to look at it, where we're starting to open up the debate, but also we're launching something new today, which looks at value creating components of ESG and how we assess that. So you'll be able to come to that one later. But I want to just open up to the panel just now. Andrew, I'm going to come to you, and Suzanne, you may want to come in on this one. And this is the question, and I'm interpreting the questions that have come in. Have you any indication about how ESG compliance potentially influences the market price of listed stocks?
Well, I'll probably refer to Suzanne on the kind of the pricing allocation, but I guess the point is around capital allocation, right? So if you look at the fact that, I mean, it's heavily weighted geographically towards Europe, but I think in the last quarter of last year, $120 billion worth of cash went into ESG related assets. And so suddenly there is a big shift of capital allocation in towards kind of heavily ESG related things. And that creates, you know, when there's a limited supply and there's great demand, that is going to influence the price to some degree. And that's not necessarily from a pure valuation perspective, but just from a pure economic perspective. So I think the way in which capital will be allocated in the future is being influenced by ESG already and will continue to be more influenced by ESG in the future. But I'll defer to Suzanne maybe for some more insightful stuff on the market price rather than just the economics.
Suzanne, have you any perspective to give? Has it affected the price?
Yes, yes. It really depends on the measures, and yes, I really would say, and even if you look at the stock market, then you could see that companies who invest in sustainable business models and in environmental issues and support, that they are in the end they are valued higher and get a better performance. That's what we already see, and what we also really see is that if you look at the investing institution, if you look at insurance companies or also the private equity business and so on, they really now focus on investments in companies who really consider ESG in their business models.
Yeah, I think, sorry, Anton, just to step in there, I think that's a really important point, because if you look at, you know, the whales, the institutional investors, etc., they're taking a much longer term view, and ESG is a much longer term view. It's not for short term returns, and that hasn't changed dramatically over the last few years. It's just that the connection with ESG and long term value creation is becoming more apparent.
Mm-hmm. Well, thank you for that one. Just before we go on to some more questions for you, the audience, Ranj, I'm just going to ask you a question at the end. I was asking Alan about the S&G part. The E was easier. From a regulator's perspective, what are your thoughts on that measurement of S&G?
Yeah, look, I think Alan made some, very pertinent observations around the complexity of the measurements around the E. So it's not necessarily easier, but I think, generally the S is seen to be a little bit more nebulous, right? It has very different components in it. And the E has increasingly, given the focus around climate, biodiversity, etc., there's a greater, if you like, sense of relative clarity around the specifics around what these areas constitute. And for example, the work of the TCFD and has been extremely helpful in terms of climate-related disclosures, etc. So I think generally there is much more now relative to some of the others. The G component, if you like, that has had relatively, quite a bit of attention as well. Governance is not new. In many ways, if you look at some of the issues that is being asked, over time, we've clearly seen that better governed companies are clearly doing better. So there is obviously, a correlation between, governance. Of course, some of the metrics that Andrew pointed out, that papers like the WEF we've introduced have many components to what constitutes governance. But the thrust of the issues are pertinent, Anton, right? Governance does have a positive link. Now, the social aspects have been, as I said, relatively nebulous. But once you start breaking it down, issues around, diversity, issues around, human capital management, etc., some of the issues that we are seeing in society today, etc., these issues are very much at the forefront. And therefore, I think, whilst it may be hard, but clearly require the requisite attention. And it goes back to the, there's a question I think that, that is out there, which I've seen has had a lot of, positive follow-up as well, which is around, the future focus on ESG, right? I mean, investors focus on ESG. And I think I think inevitably the performance of companies, the profitabilities are going to be linked on how sustainable a business model they take on. And at the end of the day, investors, we must also recognize that the demographic shift of the investor base will evolve. And as Alan very clearly pointed out, the engagement that he's having is already demonstrating when these folks start becoming influential, investors or investing in their own right, they are going to demand these aspects from companies that they are investing with. So I don't see that as mutually exclusive. I think at the end of the day, they do link back towards, ultimately what is a sustainable business model for companies.
Thank you so much, Ranjit. We're going to be coming back to you, the panel, in just a few minutes. But first, audience, we want to hear from you. So we've got a few more questions to poll you on. What do you consider to be the primary driver for ESG strategy and investment? What is it? We want to hear from you. What's the biggest threat to effective ESG disclosures for business? And then lastly, which ESG framework standards have you or your clients used? Over to you. Okay, we're just closing up here. Come on, let's get your answers in. Okay, what do you consider to be the primary driver for ESG strategy? Yeah, better reputation. Interesting. What's coming in second? Increase in overall company valuation. Interesting perspective. As I'm glad to see reducing costs is not high up there. More attractive to prospective employees, that'd be an interesting one. I think that may be more of a debate in the future. And alongside that, improve retention rates. People want to work for a company with purpose. But then it's also more attractive potential investors. Yeah, very interesting. 17%, a moral obligation to improve it. And I'm glad to see nobody's saying there is no value there. So what's the biggest threat? Well, we've heard it over and over again. There's a lack of standardized and recognized approach to that. And interestingly, so which framework is being used? So we've tied at the top here, GRI and Sustainable Accounting Standards Board. Interesting. It'll be interesting to see how this one levels out. Is it Betamax or VHS as we go forward, and how are they going to work together in the future? So thank you, colleagues, for your perspective here. Ranjit, I ended with you in the last session, but I'm going to come back to you again from the perspective of the regulator. We looked at that last question there about the consistent standards, and we're seeing two eminent ones coming to the fore. But from your perspective, and I know what the answer is going to be, but I think it's important that you see it, how important is that we have globally consistent standards?
Well, I think Anton, the answer to that is, I think it's critical, really. I think it's just demonstrated by the comments that we made in the panel, plus the questions that are coming out. There are, for all the reasons that have been said, I think there needs to be some sort of consistency, which is extremely relevant. Also, I think, in many ways, many view the discussions in the context of financial reporting, right? I mean, if you think of financial reporting, I mean, whether it's the clarity and commonality of frameworks, whether it is the ability to have assurance being provided, etc. People have a frame of reference, partly along those lines. And I think in the sustainability reporting space, whilst to be fair, I think a lot of good effort has been put in, and and as the audience picked up, folks are using the GRI, SASB standards, etc. I mean, these voluntary standard setters have done a tremendous job actually in terms of moving the needle, and are to be commended in their efforts. But I think given the scale of investments, given the scale of financing, given the scale of funds which are now being set up along these lines, you need to be able to address have the common set of standards available. So the view, I think, is that there must be efforts directed to that level. The approach should be one on building on the work that's being done by these voluntary standard setters, including the TCFD, and therefore this effort currently taking place on using prototype climate standards, I think, is the right approach, and it needs to be placed within a structure that has a governance arrangement that gives it wider credibility, and that's where the IFRS, I think, initiative is an important one and is an encouraging development. So that's my view, Anton.
But I mean, Ranjit, given the senior leadership role you've held in IOSCO, what do you think the approach IOSCO is going to take going forward? I know they have been making some comments. Where do you see it going?
Well, I think it is there are several dimensions here. First of all, IOSCO is the oversight body, has an oversight role in the monitoring board, which oversees the IFRS Foundation. So in a way, that's the same, where the International Accounting Standards Board, as you know, currently sits. So having that oversight, I think, does strengthen the approach in terms of, the governance arrangements. The second very important aspect is that any standards which, so it goes back to your question, what is going to be their role? I think the second aspect is any standards that are produced by the, in terms of sustainability board or whatever it's called, has to be endorsed by IOSCO. And, as 20 years ago or whatever, the International Financial Reporting Standards were endorsed by IOSCO before they were widely applicable across jurisdiction. So IOSCO has a process to be able to ensure that endorsement. And they've set up now a technical expert group within their structure, which is co-chaired by the US SEC and the Monetary Authority of Singapore, which is intended to be able to play a role in terms of doing the technical evaluation of whatever standards are being produced. And all this is happening very fast, actually. So that is going to be the second role which comes in. And then finally, I think it is ultimately going to be then a decision by individual jurisdictions as to what extent do they internalize these standards and have a voluntary, mandatory, or whatever approach that's taken. But that becomes a third pathway in terms of individual jurisdictions. And there, I think it's very important that the institutional structures, the legal specificities, etc., of each jurisdiction, including emerging markets and regions, are reflected once you get to that aspect, Anton.
Thank you so much, Ranjit. Andrew, I want to come over to you back to the business of investing, credibility, disclosures. What can companies do or investors do when their target either doesn't make any ESG disclosures, or if you've any doubts over the credibility of any disclosures they have made? What can you do?
Yeah, I think this is one of the biggest problems at the moment, especially when there is just such a proliferation of ESG reporting, and especially where there isn't any kind of external assurance already undertaken. Obviously, as Alan suggested, Unilever have already historically done that. And in a recent survey, it's now over 50% of people that make ESG disclosures do get some sort of external assurance on it. But that still leaves 50% of the companies that don't get any external assurance on it, and the ones that don't make any disclosures at all. And therefore, in much the same way as when you're doing any sort of transaction, it just gets built into the transaction process. So core due diligence or financial due diligence has evolved dramatically over the years anyway, and it now incorporates accounting, tax, commercial, operational, IT, cyber, reputational, and ESG is just going to be another component of that due diligence process. And for some of the reasons that we've been discussing today, it's going to become one of the most important ones, because it will reduce the, as we've already seen in the question a short while ago, it will start attracting investors, and it will start putting off investors, and that there may be a marketplace for people who want to buy bad ESG companies and turn them into good ESG companies. And there's some slightly provocative articles written about how private equity can be a vehicle for positive change in that regard. But ESG due diligence is going to be the most important area, and in that you can look to existing frameworks as a reference point for understanding it. But where you really add the value, and where we as an organization are spending our time, is doing that deeper dive. So once you identify kind of areas that are of particular concern to a company, you need to do that deeper dive. So we do things like carbon audits, so actually really assessing and understanding carbon emissions. We do human rights investigations. We do supply chain reviews, so we can undertake it at every kind of component along the supply chain. And Alan kind of mentioned that's one of the most complex areas. So even as a company at the end of the supply chain, it doesn't necessarily mean that you're good at ESG, that the whole supply chain that you're part of is good at ESG as well. And that's just as important, because that leads into, as Suzanne said earlier, reputational damage and reputational issues, and that starts to build into kind of value, etc. So for me, it's around undertaking good quality due diligence, and especially where either you don't have the right data publicly available or the data is poor to start with.
If you don't mind me asking, Andrew, here, I mean, you do the due diligence here, and I think you articulated well the new range of areas. But here's a question: do you have the skill set to do it, and how are you identifying the skills in your recruitment strategy?
Yeah,
because this is a big part of your business model.
It is.
Sure.
It is, and to be honest with you, it's the area that we've been focused on most over the past 12 months, because there are lots of people that say they can do ESG and kind of advisory around ESG and diligence around ESG, but actually embedded across our organization have been experts in most of this space anyway. We've always done carbon audits, we've always done human rights violations reviews, business investigation type work, and diligence as a process. But recruitment's critical, and you only have credibility when you have experts. Whilst I've been doing financial reporting for 20 years, it's only recently that I kind of did my foundations in sustainable accounting with the SASB, and that's only because it only existed kind of recently. But we're trying to upskill existing employees by doing such sort of accreditation on the topic. And again, our recruitment policy is heavily focused towards people with genuine expertise in this space. And again, and it might say that there is no ESG expert, because there's so many different facets to ESG that you need to have a broad spectrum of individuals that have components of the environmental piece, the social, the human rights piece, but also the governance and compliance piece. And a point I wanted to raise earlier, for me, actually, governance, is like, okay, yes, everybody does governance, and it's the easiest to understand. For me, I think it's probably the most important part, because as Alan said, they're all interconnected, but governance is really what can drive decisions in the companies around environmental and social. Good board composition, tone from the top, that really sets the tone for the environment and the social in such an important way that I think is sometimes forgotten.
Mm-hmm. Alan, I'm going to jump you here, I'm afraid to say. We've talked about accountants saving the planet, and Andrew's articulated well the skill level needed. Are we training accountants the right way for this future need?
We are on the journey. If I look around the world and I look at the professional accountancy organizations that we have, including your previous, the one that you were CEO of for many years, it is very much now part of their core education delivery. Everywhere in the world, it's on the agenda, and it's a top priority. And IFAC is, of course, as the global voice for the profession, is collecting what our member bodies are doing around the world and providing it to others so they can learn from and share with each other, so that we all get to a higher level of understanding. But I started off by using the word journey. It is a journey. And we also have to recognize that it's not just accountants. I mean, there are other professions that understand this. And when I look at the accountancy profession today, we are attracting people who've got broader degrees in environmental matters, geography, et cetera, coming into our profession, who, if you like, build on their sort of core knowledge and become experts in valuations, in assurance, in reporting, et cetera. So yes, it is a high priority for the profession, and it's one of the top agenda items for IFAC today.
Well, thank you so much. Now, I want to go back to the valuation profession. Suzanne, you're doing the job. How can ESG factors be taken into account in company valuation that you're doing just now? And have you got any examples for the ESG areas that you've actually been doing?
Yes, for example, this is my everyday business, I would say. And if I look, for example, yes, if you look environmental, for example, in Germany, that's also a client I'm working for. VW is a very huge German as well as worldwide car and truck producer, and they had these diesel scandal years before, and now they are transforming to a kind of e-mobility group, yes, and this is also a part of their transformation of their business plan, and this in the first step, this costs money, yeah, that's for sure. But in the long run, they need also, it's not only perhaps on the one hand, it's their intention and now to change their whole attitude and their whole strategic plan. But on the other hand, we have also, and they have to fulfill the political requirements. Yes, we have all these requirements regarding environmental, and for example, regarding the emissions of cars and trucks in the future, and so on. And therefore, you can really see how companies have to transform, and this you have to take into consideration in the valuation, and because it makes it totally different, because you have a total different business model in the future, and that's what makes the value in the future, and not the question what was in the past and what was the performance in the past. That does not count for the valuation of the company. Yes, and for example, social aspects, that's also, what is social. On the one hand, I already mentioned it, that you can see really a correlation between employees' satisfaction and customer satisfaction. Employees that are happy could really, bring it to the customers and will have success in the market. And the S is much wider. It's, for example, also S stands for diversity. And what we also see is that companies which are managed diverse are more successful in the market, also in the capital markets, and this is also quite an important aspect. But in this case, I fully agree. It is not that easy. Perhaps you can see, okay, if you say what I first mentioned, the link between employee satisfaction, customer satisfaction would increase the sales and therefore also the earnings of the company. Yes, but on the other hand, some of the social factors are, as we said before, the S and the G are the factors that are harder to value probably than the E. And that's it. And also with governance, it is more really the risk. If you fail in governance and really have scandals and so on, then it has such a negative impact on the reputation and so on, and could, in the end, perhaps also destroy the company.
Well, thank you, Suzanne. As I'm looking at all the questions, I mean, we could stay here for another couple of days, not couple of hours, looking at some of them. And Alan, I was just looking at one here on the accountants. Let me just find this one just now. Oh, sorry, let me find it. About who's qualified to do this. Let me find this one. Are we training auditors well enough in this area? Oh yeah, who can verify the ESG measures a company pretend they were taking? Is the auditor really qualified to do this? Or do we need to be the qualification of the auditor of the future?
Well, thank you, Anton. I saw that question. I believe so, and I'll say why. You know, at its core, and I think I might have said this earlier, we are in the business of business information as a profession. And we do have the core skills and knowledge in terms of professional judgment, which is important. So it's not that it's right or wrong. So we've got to use judgment all the time. I believe that we have the integrity, or should have the integrity. And we do have an international code of ethics established by the International Ethics Standards Board for Accountants, which oversees and guides how we operate. So I think we are well placed. Best placed. I wouldn't want to make any claims about that because I'm sure others can do it too. But we are well placed. Why? Because we have knowledge of the business. You know, when you're trying to look at value, because I don't want to use the word financial statements. In fact, I'd like to convert the conversation towards value statements, because that it's not about financial reporting anymore. It's about value reporting. You need to understand the industry that you're working in. So, you know, the auditors spend a lot of their time. The audit work is sizable, but where they need to spend a lot of the time is engaging with the business, understanding the business, understanding how they're making decisions, understanding the judgments they're making in order to reach the decisions. And therefore, the auditors should be embedded well enough in organizations and companies to understand them, to be able to ask those very challenging questions that no one else has the courage to ask. Okay. So I do believe they do, but we've got to continue to stay on top of our game. You know, what we would say in the International Federation, it's ours to keep, but we can also lose it if we don't stay on top of our game.
Thank you so much, Alan. I was just looking through some of the comments and questions there, and this is really as we're coming to the close of our event today. I mean, this is world changing or world saving. But, you know, see, when we're talking at this level, it is complex, it's not linear, it's multifaceted, it has a multitude of dilemmas. We need, Alan talked there about courage. We're going to have a lot of courage needed here to make some difficult decisions, difficult conversations, but also I'll add another word, and it's wisdom. But given the dilemma there, one of the anonymous attendees said, say for an electrical vehicle company, which should be benefiting the environment, but to run the electric vehicle, it has to manufacture batteries, which utilizes lithium, nickel, etc. Nickel in particular is infamous for having impacts on social as well as environment. How should we factor and balance these when we're valuing a company? Wow, dilemma number 422 on this one. And if we look at the rest of them, we're going to have 100 others. So colleagues, this isn't a debate that's going to be ended when we get some agreement on standards, because the standards are not going to cover every scenario or dilemma or moral issue that we're going to face in implementing this and trying to save the future of the human race and save the planet, which is in fact what it is. And what it's going to need here, and if I may say this at the end, do you know what it's going to need? A profession or a set of professions who are actively engaged in the debate on the implementation of this. Wise people, wise voices, informed opinion, and if I may say, lots of really good data to help us make some informed judgments in this. So At the end, as we come to the end, it's a call to all businesses, professions, clients, companies, all to help generate data, to make sense of data so that we can address some of these. This isn't the job of the regulator. It's not going to be the job of the standard setter. It's not even going to be the job of the IVSC. I think the IVSC here, as we've done today, is playing a part in the debate to help develop this profession that's going to help support it in the valuation role in the implementation of ESG, not just for the benefit of our businesses, but for the benefit of the whole human race. So I want to thank the panel today. You've been great. You've been tackling some difficult stuff. I really want to say a huge thank you to all the participants today. I'd love to preserve the question box because you have been asking existential questions. And for us at the IVSC, we want to take these on board and look at them as we develop our thinking going forward. I hope you'll use the resources that we do have. And thank you so much for all of you from all corners of this planet in joining us and in participating today. And to close, let me hand back to Richard.
Thanks, Anton, and thank you to all the panel for fascinating discussion today. We will preserve that question box because some of the questions haven't yet been tackled, and I can give an assurance that we will take those questions back to the various boards and working groups at the IVSC that are looking at the subject of ESG and resolve to come back with some greater clarity to some of those things. Just before everybody goes, a podcast of today's webinar will be available later this month, and you will receive a link to this in a follow-up email. The IVSC has also today published the second paper in its two-part ESG and business valuation perspective series. And this paper analyzes the impact of ESG on value creation and considers a framework to inform the capital allocation process and ESG investments. And I know that a number of questions were relating to those areas, so that might be a paper that you want to look at. You can download it from the homepage of the IVSC website from today. Finally, thank you again to Duff & Phelps, a Kroll Business for sponsoring this webinar and the entire series. And thank you to you for joining us. We hope to welcome you back to future webinars. Thank you.